Hey traders, Nick here, looking at another way of presenting a lesson with the real life trade. A few weeks ago, I believe it was somewhere on 11th, 12th of June, I shared a trade to go along Apple. So shortly after it fell, one of the trades I shared is, okay, we are going into another earnings period. Everybody's going to be worrying about Apple until between now and then, but just before the earnings, usually they like to run it up. So let's go long. I said I want it to be long. Going long, naked calls is kind of a daunting proposition, especially when markets were at all-time highs and everybody's nervous. All kinds of pundits say, hey, we're headed for a crash or whatever. So how do I minimize the risk? Usually people say, okay, I can buy the shares and hope for the best. They're pretty expensive, a high-ticket item. Or I can buy some calls, make it a lot less expensive, but pretty dangerous because calls have a time limit on them, option calls and call options, and they expire if you get the timing wrong. Even if you guess the right direction, but if you get the timing wrong, then you lose your money anyway. So one way to spread the risk is to do a spread. So usually people talk about spreads that are vertical spreads, where they sell and buy at the same time. In this case, I want to show how I can do a calendar spread and kind of like skew time to work for me a little faster than against me. And that would be what I'm talking about here today, a calendar call spread in Apple that I set early in June, well, between 10th and 12th in June. So the idea was to buy a longer dated call that has a hope of hitting or getting close to it. I don't need them to hit it. I just need them to rush towards it. And then mitigate that risk by selling something that expires earlier. So I thought I wanted to be long through the earnings, but hedging just up until the earnings. So let's look at the chart. Somewhere around here was the time where I entered. Obviously, the trade is profitable. I drew this white zigzag a long time ago. And it's not like I foresaw the future, but that was the trend I was going for. And how perfect is this action? I probably drew it somewhere around here because I probably said, okay, Apple is trying to do an ABC move, 3 pushes, whatever you want to call it. Long term, they play out. Short term, they play out too. So I got lucky, maybe. A little bit of luck, a little bit of homework. The trade is profitable. So how could I set the trade up? So let me bring in the picture of it. All right, so this is an options chain for Apple. We have all the weeks and months all the way out to 2021. And then the one in particular was October, sorry. And this is my position right there, that little green dot. So I bought the October 215 call. Currently it costs almost $6. At the time it cost only $4. So if I bought one contract, I already made almost, I'm going to round it to $6 here. I made $2 per contract. So $200 per contract. If I did 10 contracts, that's $2,000. And in a short period of time. So I can book it now and call it a day versus trying to have mitigated it. But at the time, I didn't just buy that. I bought that and then I sold something against it. And the point of this is, which one do I sell? So there is an event coming, and most likely going to be somewhere here, where they report earnings. Let me see if I can guess from the chart. This is Apple. They usually report early August. So the earnings will not be here. So what I did is I sold something there, and that's my other position, that little red triangle. So I sold that, and I collected a premium. This morning, they were both green in my favor. The market rallied into the close, so now this one is, I can't remember, I'll show you the net result. So I made $2 on the other one, and I made some extra on this one. So, and the idea is that I tried to mitigate my risk by not buying it naked. So this is the actual call calendar, how it looks like. I bought the 215, I paid $4. Now it's worth almost $6 at the time. This was earlier today. And I also sold this one, which was cheaper today. So I was making money on both ends. Yes, Windows. So the net cost is $3 to me. So ideally, what I want to happen is I want Apple to continue on below $215 per share up until the early August. So this one will expire, will disappear, and will leave me long Apple for $3.33 because that's the only thing I paid, $3.33, because I paid $4, but I collected. Oh my gosh, this pop up! I collected $71 to sell this one. And if this one dies for maximum gains, or if I close it for 10 cents or whatever, so I reduced my entry point by 60 cents or 70 cents, whatever I get out of it. So I could stay long at a discount or just book it. So that's the idea of reducing the out-of-pocket risk in order to make a bullish trade. A guess, in this case bullish because I went with calls. I could do the same with puts. If I was expecting Apple to fall, I would buy the put and then sell put against it. So here's the trick. Okay, so because I bought October 215 and sold 726 215, that's called a call calendar. There's a difference in calendar, not level. They're both at 215. Okay, so I could have bought the 215 and sold the 220 or the 217 and a half call. Then it wouldn't be called a calendar, even though there's a change in calendar. There's also a change in levels. So it now becomes a diagonal. If I draw a line, it'll be a diagonal, right? So calendar versus diagonal. You hear those often. Hey, I bought a call calendar, a call diagonal, a diagonal put, or so that's what it means. Now, what's a vertical? The vertical is just plain old Jane. I buy the 215, I sell the 220. That's the vertical, same time. So, vertical, calendar, diagonal. Okay, that's how it works. Now, there was another way of doing it. I did this with Facebook. I've done it before. I know I've done videos on it before. What if I had simply bought this and not sold anything? So, I paid $4. And now it's $6. How can I lock in my profits? Now this is a separate lesson here. I can lock in my profits by selling the one above it and collecting more than what I paid to enter this one. So I can sell the 220 and collect $4.30. Remember, I paid only $4. So now I got paid 30 cents per contract to be long Apple, and there is absolutely no way I could lose. This money is pure profit. And now I'm holding a ticket that could pay me even more, because whatever the spread cost right now, it's 6 minus 430. That is the cost of the spread, but the maximum value of the spread, if Apple goes to 1 million or if Apple goes to 230 or 225, it should be $5. Not just the difference between 6 and 430. It's the full value should be $5. The reason it's not $5 right now is simply because there's time on the clock. There's still 100 days, 107 days. So if the movement is up for the earnings, if Apple spikes, I got paid to make even more money. So I got paid to be long. There's absolutely no way I could lose. I lock in my profits. Okay. At any point in time, I can change my mind and sell the whole thing, and that'll be profit. So, but 30 cents is locked in because I paid $4. I collected $4.30. The end result, I'm still in a bullish spread. So there's only upside to go. So that is how I can lock in profit without not having done it from the beginning. I can still do it in other time frames. So I can go to August and say, okay, I want to sell this one and collect more. Keep a diagonal going, or create a new calendar after the fact. But as it is, the scenario was I bought something, I sold something. Even if I didn't sell something, I can sell it now. Okay. Hopefully this sheds some light on a little bit of the jargon. I'm going to recap. To go long something, I can buy a call naked, other than buying the shares. I can buy a call spread, or I can buy a call diagonal, which is buying one, selling one closer in time, or I can buy a calendar, or I can do a call diagonal where it's similar, only I change the levels. Sometimes I change the levels down. I did that with the SPY. I bought a 301 call and I sold a 298 call that expired on the 1st against it. So I took in a lot extra risk between 298 and 301, but it was a safe bet. It expired worthless, so now I'm long the SPY slightly cheaper than I would have had I bought them naked. All right, so if you have any questions, let me know.